Stock market movements are cyclical in nature. It is impossible for the market to continue trending in only one direction. Furthermore, stock market movements are also highly volatile and unpredictable. As such, you never know when the next stock market crash is around the corner. In these circumstances, protecting your investment from the aftermath of a sale becomes very important. If you're looking for information on how to avoid a stock market crash, you've come to the right place. Here are some tips for avoiding a stock market crash. Prepare yourself for a crash. One of the best strategies to prevent a stock market crash from affecting your investment is to prepare well in advance. Ways to prepare for a sale include diversifying your investment portfolio to minimize the impact of a crash or investing in lower risk options. These two steps won't help you avoid the impact of a crash entirely, but they can greatly prevent a significant decline in the value of your investment portfolio. This is how you can safely weather a storm without lingering effect. Watch out for the signs. Stock market crashes rarely happen overnight. In most cases, there are clear signs of an impending crash. If you're looking for ideas on how to avoid a stock market crash, just look carefully for the signs. Signs of an impending major market sell-off are almost always geopolitical and linked to disease outbreaks. Whenever geopolitical tensions rise or an outbreak of disease winds up, always try to exit the market early. You can also protect yourself from the negative aspects that cannot be avoided. The current economic scenario for the country and the world is another important indication. A weakening or declining economy sooner or later always leads to a market decline. Set a stop-loss target. This is definitely one of the easiest tips to avoid a stock market crash. A stop-loss is an effective tool that helps you limit your losses if your investment decisions don't go as planned. Essentially, it prevents losses from falling below a certain level. Whenever you buy a company's stock, be sure to set a stop-loss target immediately. This will reduce your capital loss should the stock fall as a result of a market crash. There is a caveat here. There is no such thing as a perfect stop-loss, but we recommend aiming to invest no more than 10% to 15% of your purchase price. Invest in defensive stocks. Defensive stocks, also called non-cyclical stocks, are generally well-established companies involved in the manufacture of essential consumer goods and services. Because these companies almost always produce goods or provide services that are in demand, they tend to be profitable and financially sound even in tough economic times. Defensive stocks are generally considered safe investments, minimizing the impact of market crashes. Their valuations don't go down much when the market is in deep sell mode. Investing in defensive stocks is therefore one of the most popular strategies to prevent stock market crashes from impacting investment portfolios. Don't rely too much on the market. The best way to avoid a stock market crash is to limit participation during times of uncertainty. This effectively means that it is best not to open new positions, long or short, when the market is expected to sell out. Sometimes it is much better to stand back and observe the situation than to try to initiate a new investment decision or strategy. This way, the chances of being hit by a stock market crash are zero, and when the chaos subsides, you can enter the market and profit using a buy and hold strategy. Conclusion: even if you get stuck, remember that the stock market is cyclical in nature. There's a good chance that you'll recover, so don't worry. You can also take advantage of the opportunities that come with market crashes to buy cheap and earn decent returns when the market recovers. With these pointers in mind, it becomes relatively easier for you to prepare yourself from the adverse impact of a market crash.